Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at three strong buy tech stocks to consider adding to your portfolio as we enter that midway August point. Consider maybe as longer term buys as well. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these three strong buy tech stocks, I like to always start with just a brief, broader market overview. So the S&P 500 and the Dow both notched new record highs to end last week, with both the blue chip and the benchmark index down slightly through mid-afternoon trading on Monday. The NASDAQ was down the biggest as of the last time I checked on Monday, but it's still hovering within around 1% of its highs. So the market's still at right around record highs for all three of the major U.S. indexes. So we saw last week reports from Disney, Tyson Foods, eBay, Airbnb, and countless others who reported following a couple weeks of massive tech reports. And then this week, the week of August 16th, will feature reports from big retailers like Walmart, Target, and some other big retail names. So far, the S&P 500 earnings season has been really stellar, and the outlooks continue to improve. So along with this earnings positivity, we saw a pretty impressive July jobs report that came in with the U.S. employers adding around 943,000 jobs last month to easily beat expectations and mark the biggest gain since August of 2020. Meanwhile, unemployment rate fell from 5.9% in June to 5.4%. That put the jobless rate at its lowest level since the early days of the pandemic back in March of 2020. So all positive signs there. We also saw a couple weeks ago now, Goldman Sachs lift its 2021 target for the S&P 500 up to 4,700 from its previous 4,300, which at the time represented about 7% upside for the remainder of the year, with it currently representing about 6% upside for the rest of the year. The Wall Street Titan also lifted its 2022 target and continued to cite that positive interest rate environment that's favoring stocks, even when the Fed does start to slowly raise its rates off those rock bottom levels. So with this in mind, there could certainly be some more near-term selling with the market once again at highs. And we saw that quick bounce back already from a recent sell-off. But longer-term bullish investors, the longer-term bullish case remains in place despite some Delta coronavirus variant worries, economic slowdown concerns, and rising prices. That said, that is barring any major new restrictions or lockdowns, but unless things get really bad, all of a sudden it's unclear what kind of political will there will be for those new restrictions, especially since so many places in the United States have kind of just got back into the swing of things in the last couple months or so. So with this in mind, we're going to take a look for some stocks that you might want to consider adding in August and beyond that seem not only like solid buys for the moment, but longer term investments. And we're going to start with Sonos, which trades on the ticker SONO. So it's basically its name minus the S is the ticker. The stock had soared from around $15 a share in October of last year to over $40 in a roughly 6-month stretch. The shares of the high-end home audio firm then fell about 25% from mid-April, heading into their third quarter 2021 financial release on August 11th. But the stock has surged since then on the back of strong earnings and some good news in terms of a patent dispute that we will touch on a little bit later. But before we turn into as I said, that recent news in the report, it's time to kind of break down the stock and the firm for anyone who might not be very familiar with Sonos. So Sonos is a home audio firm that specializes in wireless and multi-room sound systems. The company competes against and is often compared to Bose. It sells a range of sleek connected speakers, subwoofers, sound bars for TVs, and more, enabling people to build on their home audio collections kind of as you go. I actually was gifted a Sonos speaker for Christmas, and it's great and fantastic, and we can now add on to that if we see fit going forward. Sonos, as we mentioned, sells speakers individually and in packages with surround sound sets that can cost up to about $1,900 at the moment. The speaker firm's quality and functionality help it thrive in a crowded market that includes tech titans such as Apple and many others. Sonos also sells what it calls architectural speakers and sound systems that can be placed into walls and ceilings depending on how you want your home set up. Overall, the company has certainly benefited from a shift to modern connected devices as people kind of move away from those older, bulkier offerings from everything from sound systems onward. This spring, Sonos also entered the popular portable smart speaker market. Its Wi-Fi and Bluetooth-enabled Roam costs about $170 and is now certainly its most mass appeal speaker. We should also note that last November, it rolled out a new ad-free HD streaming tier of its radio service. So that's that Sonos Radio HD. It costs about $8 a month and competes against Spotify, Apple Music, and others. With that said, Sonos has struggled, or it did struggle early on after its 2018 IPO, but it took off from the market's coronavirus lows alongside countless others, and the stock benefited from broader at-home spending. So we saw the stock jump from around $9 in March of 2020 to hover around $15 by October. And then it really went on a massive run after it crushed Q4 estimates and announced a new $50 million repurchase program last November. Sonos, as we mentioned, Sonos was then trading about 25% below its highs heading into its report on August 11th that saw top estimates with revenue up 52%, gross margins up 300 basis points to 47%. We also saw the company report positive earnings of 27 cents per share, which came in well above our estimate that called for actually an adjusted loss of 17 cents per share. So the company's now posted back-to-back quarters of positive earnings when we had called for an adjusted loss based on our Zacks estimates. So the company has gone on to crush estimates for the last 4 quarters. So looking ahead, Zacks estimates call for Sonos's full year 2021 revenue to surge 29% to $1.7 billion, with FY 2022 set to pop another 10%. So about 30% growth this year and then another 10% next year. These would come on top of 11% expansion in 2019 and 5% sales growth last year. So solid 4 years for Sonos. And then on the bottom line, Sonos is expected to soar from an adjusted loss of 18 cents per share last year all the way up to positive $1.07 per share this year, with it then expected to continue to climb even higher in 2022. As we mentioned, the stock has soared recently. So it popped after its August 11th release, and then it soared after hours Friday. This came after news broke that a U.S. trade judge found that Apple's Google was and currently is infringing on 5 Sonos patents. So the decision could shut down some Google smart home devices, phones, laptops out of the U.S. market. There's still some uncertainty on what's going on at that point, but the stock was up over 10% after hours on Friday, and it was up big through morning trading Monday as well, up over around 10% again. It's cooled down a little bit, but still the stock is up it's gone from $33 a share last week to now trading at about $42. So it's just sitting a few dollars off its records. It's now up about 75% in 2021 and 185% in the past year. So despite trading once again right near its record highs, it's trading at about 31.3 times forward 12-month earnings, which comes in well below its median over this stretch and at a huge discount to its highs where it was trading at one point in the last, this is the last 6 months. It was trading at 50 times forward earnings. It's now trading at 31 times. So really positive outlook on the earnings front. The stock could experience some near-term selling given that it's surged so quickly in the last several days, which has also put it above overbought RSI levels. So that's that 70% threshold, with it currently at about 77 at the moment. So we could see some near-term selling, but Sonos lands a Zacks Rank #1 strong buy at the moment, given its recent positive earnings momentum alongside A grades for growth and momentum in our style score system. We should also note that the speaker firm's balance sheet is pretty solid with no debt on the books at the moment. Plus, its CEO remains really confident that they're going to be able to capture more of the broader premium home audio market. And they see the company being able to kind of expand through a bunch of different larger factors, which he went into a little detail. So quickly, I'll just name. So first, he calls the golden age of audio, which he sees that they're well positioned to capitalize on the continued increase in audio content consumption in new audio formats that are emerging. Second, he referred to it as Hollywood at home. So that's just more and more people not going to the movie theaters in the last year and a half of lots of movie theaters being closed and movies going directly to video on demand. Could just be a trend that's hard to fight against as people get used to watching movies at home. And then third, he called it, quote, the great reshuffling, which is the untethering of people from their offices, enabling flexibility on how and where to live, while the drive to continued investment at home, a trend that our premium brand is designed and well suited to capitalize on. So just broader trends, as we said, more and more people are buying these sleek, smaller, connected devices that they're able to put wherever they want in their home. They're less bulky, less cords. And Sonos is certainly a big player in this news on the Google front could really propel the stock going forward, depending on what actually comes of that. But so far, the stock's been pretty impressive in the last year, and its growth outlook is pretty strong as well. And now we're going to move on to a company that has not really needed an introduction in years, if not decades, and that is Apple, which trades under the ticker AAPL. The company topped our Q3 FY 2021 estimates at the end of July, and it highlighted its profitability and growth, not to mention its commitment to buybacks and dividends. So Apple's recent report further cements the strength of its non-iPhone business. So despite trading right at new records, Apple's valuation appears pretty solid, and it could be prepared to keep climbing since it's still actually underperformed the broader tech space in 2021 and over the last 12 months. So we're going to go into that recent report and then talk about some other fundamentals for Apple. So Apple posted blowout Q3 results on July 27th, with revenue up 36% and adjusted earnings 100% higher. The company's flagship smartphone helped drive this growth, with sales of iPhones up 50% for one of its strongest years in that segment in a long time. Apple also continues to enjoy strong expansion outside of the iPhone, which is key. So smartphone sales accounted for roughly 49% of Q3 revenue. If we look back over the last several years, iPhone sometimes would make up over 60% of total sales, especially in a strong quarter like iPhone just had. Mac sales were up, iPad sales were up. That wearables, home, and accessory space was up 36%, driven by the success of its AirPods and others. And perhaps more importantly, its services unit was up 33% to account for 22% of sales, which made it easily the second largest space behind the iPhone. Apple sells high-end consumer electronics. We all know this, and it was able to pull in $275 billion last year during the height of a global pandemic. And that's kind of really the broader pitch. The company's branding prowess remains nearly unmatched in that constant cycle of new phones and devices, keeps people wanting more. In fact, many consumers upgrade to new iPhones and other devices almost habitually, even if there isn't necessarily a game-changing difference between the new model and their current smartphone. And many Apple customers rarely even consider buying anything other than an iPhone, opting sort of just to stay in that broader Apple universe continually. The company said on its January call with analysts that it reached over 1 billion active iPhones with about 1.65 billion total devices. Apple didn't provide specific updates to those numbers on its most recent earnings call, but they are likely higher given that its CFO said that it reached all-time highs for installed base of active devices. So clearly they're up from those last numbers they provided. Apple's long-term growth case is also clearly not difficult to make in a world full of smartphones and people simply just addicted to their devices. And that growing subscription is also huge. So Tim Cook, which is the CEO, is focused on transforming Apple far beyond that iPhone, as the company aims to continually make money from those loyal and growing customers we just talked about. So these services include everything beyond its App Store as well. So this includes Netflix and Spotify competitors, subscription news offering, Apple Wallet, a video game platform, digital workout classes, and much more. So the company's most recent period, it finished with 700 million paid subscriptions, up 150 million from the year ago period. And the company noted that it was nearly 4 times the number of paid subscriptions it had only 4 years ago. So that subscription business is continuing to boom, and it will help provide more stability going forward as well. The company has also brought more of its chip making in-house. These efforts will one day help it possibly create what it's referred to as a closed loop. Apple has also made news over the last year plus, and more recently for its privacy efforts that now impact the likes of Facebook, though they've come in the news for some reasons people are getting very upset about. We're not going to get into that at the moment, and Wall Street's largely ignored those stories and headlines over the last week, with the stock back up to new highs. Executives also did say that they expect to experience some supply chain setbacks in Q4, with those, quote, supply constraints set to, quote, are greater than we experienced during the June quarter. So basically, they're just expect to be more setbacks than they saw last quarter. With this in mind, Zacks estimates are still calling for Apple's adjusted Q4 earnings to climb 68% on 31% stronger sales. So still calling for a really big quarter. More broadly, its full year 2021 revenue, is expected to climb 34% from $275 billion all the way to $367 billion, which would crush last year's 6% growth and mark its strongest top-line growth since 2015. Meanwhile, its adjusted earnings are projected to climb 70% this year, and it's then still set to grow both its top and bottom lines in 2022 on top of that. Apple's positive bottom line revisions help it grab a Zacks Rank #1 strong buy, and it almost always beats earnings estimates. This run includes a 30% beat last quarter and a 40% beat in Q2. As we touched on at the outset, Apple has underperformed its technology peers over the last year. It's up 30% versus the tech sector's 43% climb. In 2021, tech is up 23% against Apple's 13% climb. So this underperformance at first glance might seem a little odd given all of the things we've just talked about. But Apple, like all stocks, is always at the risk of underperforming an index or other benchmarks during various periods of time. This is part of the reason why timing stocks can be so difficult. So Apple's inability to outpace tech over the last 12 months is most likely due from the fact that it had previously skyrocketed from its COVID lows until right around its stock split in August 2020. So over the past 5 years, Apple stock is up 450%. This crushes the tech sectors. Around 175% climb. This crushes Amazon and Microsoft. Apple's up about 5% now in the last month, and it hit new highs Monday of just over $150 a share. And it still sits below overbought RSI levels despite this recent pop at about 65. Even though the stock price sits right at new highs, Apple is trading at a nearly 30% discount to its own year-long highs in terms of forward earnings, and it marks 10% value against its own year-long median. And it's also trading at a discount compared to the broader tech sector. So given this backdrop, now appears to be a solid time to consider buying Apple. And longer-term investors don't really need to try to get fancy and overthink that owning Apple is too easy and the stock is certainly no hidden gem. But at a certain point, who really cares? If you're exposed to the broader market, you're exposed pretty heavily to Apple as well. The company is a cash cow. It returns that money to shareholders through buybacks and dividends. About $29 billion worth of that just last quarter alone. The company closed Q3 with net cash of $72 billion. So this is net cash, so minus their debt. It plans to keep rewarding shareholders as it slowly tries to reduce its cash position. And that massive piggy bank also allows it to pursue new areas of tech. And that includes ones that are not even on the radar at the moment. That said, Apple does face some legal battles regarding its own highly profitable App Store, but Wall Street doesn't seem particularly worried with the stock, as I mentioned, at new highs. And when we've seen strong demand for its first 5G-capable iPhone. Wall Street also remains very high on the stock, as we just mentioned, with 18 of the 24 brokerage recommendations that Zacks has coming in at strong buys, with 4 more at buys and none below hold. So some might still want to attempt to wait for maybe a more enticing entry point, or opt to search for the next Apple. But if you want to add Apple to your longer term portfolio, it certainly doesn't seem like much of anything else but a layup, especially if you're thinking not just within the next couple of years, but within the next 10 years. So buying Apple at its peak sometimes might scare people, but think of all the money you could have left on the table if you were worried about buying Apple at its peak 2 years ago or 3 years ago or 5 years ago. So if you have that kind of investment horizon, it certainly doesn't seem like much of a risk at this point to buy Apple, especially considering all the things we just talked about, and it's sitting at a Zacks Rank #1 strong buy. So last up today is Shopify, which trades in the ticker SHOP, so SHOP. Shopify helps companies adapt to the future of retail by building, maintaining, and growing their e-commerce presences. The firm boasts that it powers over 1.7 million businesses in more than 175 countries. Shop makes money from recurring subscription fees and add-ons. The company offers different tiers aimed at everyone from entrepreneurs and small businesses to higher volume merchants and bigger businesses. As we mentioned, the Canadian company has basic packages that cost X number of dollars per month, and then you pay transaction fees. Shop also has point of sale products and software that have gained momentum as they compete against the likes of Square and other companies. It's also partnered with heavyweights of the broader retail space. This is Walmart. It's also partnered with Facebook, and all of this is necessary as it tries to compete in the Amazon age. And this is why every company from various industries and countries around the world are trying to have an e-commerce presence. And we should also note, and it's really important, especially given what the stock's doing recently after its recent earnings report, that Shopify was far from a one-hit COVID wonder. For instance, Shop was up from under $30 a share in 2016 to over $500 before the coronavirus crash. Its sales supported that growth with 2019's 50% growth. Actually, it's slowest since it went public in 2015. With this backdrop, the company's 2020 revenue then skyrocketed 86% from about $1.6 billion to $2.9 billion. It then beat Q1 estimates, and it topped our Q2 projections at the end of July. So its sales were up about 57% to about $1.19 billion. This marked its first billion-dollar quarter on record, with its adjusted earnings up from $105 a share a year ago all the way up to $2.24. This crushed our estimate by 130%, and it's now beat our estimates by 111% in the trailing 4 quarters. Looking ahead, Zacks estimates call for its 2021 revenue to jump 57% from about $2.9 billion all the way up to $4.6 billion, with 2022 then expected to surge another 33% higher all the way up to about $6.13 billion. Meanwhile, its adjusted earnings are projected to climb over this stretch by 11% and 13%, respectively. So continued growth. Obviously, hearing 33% might shock some investors, and it might get some on Wall Street nervous, but it's still, that's just the law of large numbers. We're calling for 57% more growth this year to go from 2.9 to 4.6 billion, with then 2022 expected to jump all the way up to 6.13 billion. So just massive year over year growth, especially if you look at it on a non-percentage basis. Shop has also been a standout on Wall Street for a long time, with the stock up, as we mentioned, from around $40 5 years ago to its current levels of well over $1,600 a share. Or at one point, it was over $1,600 a share. It's now right around there. So the stock has cooled off a bit. It's up about 48% in the last 12 months. This lags behind Target and many others. And it has regained some of that momentum, though. It's up about 40% in the last 3 months, and it hit new highs of about $1,650 a share. This was prior to its release, and it's now down about 9% since July 23rd, with the recent pullback pushing it right near neutral RSI levels at 50. So that's a positive sign. Shop sits, as we mentioned, it's trading 9% below its recent records, near neutral levels. So that could be a positive sign that we could see some more near-term selling as people might be a little nervous about the idea of only 33% growth in 2022. But Shopify has had some really strong post-earnings revisions on the bottom line to help it land a Zacks Rank #1 strong buy. And currently 16 of the 29 brokerage recommendations that Zacks has are strong buys with only one sell. The stock does trade at a premium compared to its industry, but it's trading at about 33.5 times forward sales at the moment, which is 30% below its year-long highs and below its median as well. As you mentioned, there's been some near-term selling pressure. We could see some more near-term selling pressure, but longer-term investors might want to consider adding Shopify stock given its ability to thrive going forward. And once you're in the Shopify world and once you have an e-commerce presence and you're doing a lot of business online, you're not going to just stop because this is only really going in one direction. And it's worth noting e-commerce still has miles of room left to grow, and we're really far from the peak of it, considering that e-commerce only accounted for about 14% of total US retail sales in the first quarter of 2021. This was down from a peak of 16% in the second quarter of 2020. So that was the height of the pandemic. So all three of these stocks certainly appear to be worth considering both in the near term as in longer term buys within this broader tech space, especially if you have an investment horizon of several years or far longer than that. It's certainly worth considering Apple. Obviously, that's almost a layup. It's the biggest company in the market. Shopify, and then Sonos is one of the smaller players, but it certainly looks to be a stock that's worth considering. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. Remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.